I'd like to introduce our speakers, John Eliason, Mark Christy, and Wolf Pohl. John, over to you.
Yes, thanks, Joe, and hi, everybody, and thank you for joining us today. As Joe was saying, that we're talking about the final regulations that came out last week, uh, and we're excited to talk about this with you. Uh, the ITC regs that were in place before the final regs came out were originally published in 1981, and the regs were last amended in 1987. Which is before many of the current types of energy property became eligible for the ITC under Section 48. And without any updates, in between that 1981 and 1987 period, we also had an entire rewrite of the Internal Revenue Code. We've struggled as an industry, as tax professionals, in just bouncing around old regs that seemed in many ways to be out of date and looking at obsolete concepts and applying them to our current projects. So it was really overdue to have new regulations in this space. The new reg project actually started in 2015. So it's gone on for 9 years. It was put on the shelf and then restarted again after the enactment of the Inflation Reduction Act in 22. Our proposed regs were released in November 23 and then corrected in January and February 24, with final regs released on December 4th of last week. The final regulations represent the views of the Treasury and the IRS in consultation with the Department of Energy with respect to many of the things that are just fundamental in understanding and applying the ITC code provision to various types of energy property. The regs talk about qualifications, what constitutes energy property, what's excluded. It talks about the meaning of energy projects, which is relevant for prevailing wage, domestic content, energy community purposes, and then provides specific rules applicable to energy property, many of which we'll talk about today. And for the most part, the final regs do follow the proposed regulations. The timing is really interesting, though, right? We've been waiting for 9 years for these to come out once they were originally introduced back in originally the project started in 2015. But they're really only applicable for projects that begin construction prior to December 31st of this year. After 24, we switch from Section 48 of the code and Section 45 on the PTC side to what's known as the tech neutral credits, which will exist in Section 45Y and Section 48E of the code. So that's just, we find it interesting at the timing. While some of the concepts in the final regs are also reflected in the proposed regs for the tech neutral credits, those proposed regs were released in June 24. It does remain to be seen whether we'll ever even see final regulations. There's no obligation for Treasury to finalize regs. They can just stay out there indefinitely, or they can be withdrawn. And they don't have the force of law associated with them. We have to get to that final reg position to have that in place. So that's really kind of the table we're setting for today. What we're going to be spending our time talking about today are the some of the issues that we get the most questions about. And we're also going to talk briefly about the impact of change in tax law, and then we'll have time for questions. Mark, I think you're going to start us off in talking about the meaning of energy property.
Yeah, thanks, John. So determining what constitutes energy property is important because the ITC is claimed with respect to taxpayers' basis in energy property. And so that concept is discussed throughout the regulations. There's also the concept of an energy project, which we'll get to later, which mostly came into the code with some of the new Inflation Reduction Act provisions, like the prevailing wage and apprenticeship requirements and the tax credit adders. Section 48 lists out various types of energy properties, and the regulations provide some details into what falls into each category, such as solar and wind and qualified biogas and some of the others. The final and the proposed regulations are mostly very similar, and the focus is more on a function-based approach rather than a technology-oriented approach, where Treasury is really looking at whether a particular piece of property performs the function that's intended under the statute, but doesn't get into a lot of specifics. Also consistent with the idea of allowing for new types of technologies to come forward and maybe meet the definitions without locking in specific types of technologies. And it's also consistent with the transition that John was mentioning previously, that where next year taxpayers that start construction will be under the tech neutral tax credits rather than specific types of energy property. There are also a list of general requirements, and these aren't really new, but the regulations go through some of the general requirements that are required for energy property. One of them is that the original use must start with the taxpayer, so the property has to be new and generally placed in service by the taxpayer. If the taxpayer is going to upgrade existing equipment, the original use requirement generally requires taxpayers to comply with the 80-20 rule, which has been around for a while, and these new regulations don't really change those rules. Under those rules, if a taxpayer has an existing property and claimed ITC, and it wants to add new components to the property to claim ITC, then in general, taxpayers comply with the 80-20 rule, which means that the value of the used property that stays at the property has to be less than 20% of the value of the used property plus the cost of any new components that are added. And so it's sort of a way of saying how much, effectively, like how much the taxpayer has to add to a project before it's something that's new, and then the taxpayer would be able to claim ITC with respect to the new equipment, and the original use would be deemed to occur with respect to that energy property. The next requirement is that the property depreciation or amortization must be allowable for the property. So generally, that property has to be used in a business and must be placed in service. If there are any performance and quality standards in effect, then the property has to meet those. There are certain types of properties like small wind energy property and electrochromic glass property that have specific performance and quality standards, and the regulations kind of provide some details on how those are used. The property also can't be part of a qualified facility where a PTC is allowed. But like the proposed regulations, these regulations specifically provide that where you have co-located, battery plus solar, the battery is a separate category of energy property. So claiming solar with respect to, or claiming PTC with respect to the solar and ITC with respect to the battery storage is okay and doesn't implicate, the ability to claim the ITC on the battery, even if they're part of a single project, as we'll get to later, or share equipment like transformers or something like that. And then finally, if there are specific dates for start of construction or place in service for specific types of property, then taxpayer would also have to meet those. And so those are the basic general requirements. And then the regulations really sort of divide up property into two kind of categories: units of energy property and property that's an integral part. And I think that sort of division of those property and kind of helps explain a lot of the concepts throughout the regulations, understanding that division. But pass it over to Wolf to talk a little bit about those.
And before you switch over, you kind of look at the general requirements, and it seems really straightforward, right? So you kind of wonder what we do all day long, right? And I think it's really it's important to remember that every single one of these general requirements has nuance in it. And Mark talked a little bit about the one with respect to the retrofitted, the 80-20 rule to encourage people to restart a project, start a new place in service date for a project by making a substantial improvements to it. But yeah, I mean, there's the devil's in the details, right, Wolf?
I think that's right, John. I mean, I think when you look at when we kind of read these rules, as you're saying, it seems pretty straightforward when you look at how it's described. Yet when you actually try to apply it to all the different types of projects that can qualify for these credits, that's where the detailed interpretation comes in, and that these kind of simple concepts, as they seem to be laid out in the regulations, get a little bit harder to interpret. And that's why it's helpful to have this guidance, not only the regulations, but also the preamble, which gives us some background on what Treasury is thinking in terms of how we identify the relevant components and what counts and what doesn't count for purposes of these various tests. So as Mark was saying, the kind of general starting point for ITC is the unit of energy property. And so that's the functionally interdependent components of a property that are needed to operate it. And then you look to whether that unit can be operated separately and apart from all the other units of energy property in a larger energy project. And so prior to these regulations, kind of the most specific thing we were using on this topic was a different set of guidance, which related to wind projects, which said the qualified facility for a wind project was the wind turbine, the tower, and its supporting pad. And so in the solar context, we'd be trying to figure out what's the equivalent to a turbine in the solar context. If I have a large solar project, what components do I break it up into? And kind of historically, that was looking at blocks of energy property, blocks of solar panels, or sometimes people use the term power conversion unit, or inverter string. These regulations clarify that for solar, they think the right way to look at it is all the panels that connect to a common inverter. So helpful in that it helps us figure out what the relevant unit of energy property is for solar, kind of similar to the wind guidance that we had before. And instead of applying it by analogy, we have some more direct guidance that the inverter string level is kind of the right way to look at it in larger solar projects.
And
They have a separate rule.
That's always been a question on our deals, right? It's just like, how do you recognizing these large utility scale solar projects, how do you break it up, right? Because it's important to understand when the ITC is going to get triggered.
That's right. And whether you've placed a particular unit of property into service or not placed it in service, do I look at the project as a whole to see if it's been placed in service, or do I need to look at each inverter string separately? So that's been something that the entire industry has been focused on even prior to these regulations, but that's certainly helpful that we now have kind of more clear guidance, which I think was consistent with how a lot of people thought about it in the first place.
I do think it makes it a little easier because this is something that in a financing transaction or certainly a tax equity, the developer is taking the risk on a place in service questions usually. So I feel like,
Yes,
I really like the clarification and the final regs really being very specific on it. I feel like that's going to give people some calm as to kind of what they've been agreeing to in the past.
I think, yeah, that's a good point, John, that going back to your point about the rule itself, when we read the general rule, it seems pretty simple to apply. But then as we apply it to a particular piece of technology, how do we kind of match up those more general terms in the rule to specifically what's being built on the ground? And so having specific examples like this, like it's the inverter string that is the unit of energy property, is very helpful and provides a lot of clarity and certainty for purposes of getting projects financed.
Yeah, in the comment section, there was a question about batteries, right? It's like the people wanted to see some specific rule on batteries.
Yeah, so they declined to specifically identify kind of the unit of energy property for all battery storage. They said it's kind of going to depend on the facts and circumstances of a particular battery system. So from that perspective, that's a little bit less helpful than what we have from solar. I think for the larger battery systems, we can probably look at it the same way as solar, meaning if you have a bunch of battery blocks or battery cells that are connected to inverters, but you have multiple inverters in your overall battery project, probably the right way to look at it is going to be inverter by inverter. And I would expect a lot of people to take that approach, even if there's no further clarification later in the regulations. But it would have been helpful if there had been a little more specificity on the storage front there. Certainly because it's also kind of early days, these last 2 years, right, that we've been doing standalone battery storage as eligible for ITC. And so there's been a lot of questions coming up as well around how do I look at a storage system as compared to solar? What are the differences? How are they similar? But I do think this inverter by inverter example in solar is probably going to carry over by analogy to at least the larger battery systems. Another specific technology that they spent a fair amount of time on in these final regulations is the biogas. So qualified biogas gets an ITC, but there's a lot of questions around what specifically I should count as the limits of my qualified biogas property. And in particular, as you had mentioned at the beginning, John, there had been some corrections to the proposed regulations. So the original proposed regulations said that gas upgrading equipment would not be considered as part of qualified biogas property. The IRS then corrected the proposed regulations, saying that gas upgrading equipment could count if it was integral to the overall biogas property. The issue there left the question of, well, how do I know if my gas upgrading equipment is or is not integral to my overall biogas project? And that's kind of a definitional question in a sense. How do I define my biogas project? So these final regulations actually kind of took a different approach and said, gas upgrading equipment is part of the cleaning and conditioning equipment and therefore is part of the qualifying biogas property. So that kind of helps settle that issue, which had been a kind of a point of concern for the biogas projects. Another helpful thing that they did on the biogas front was the biogas rule says it doesn't count if the biogas is going to be combusted. But you do need, typically, as I understand it, in these biogas plants to flare excess gas, sometimes for safety reasons or because you can't you're kind of at capacity in terms of putting your gas onto the pipeline. So the regulation clarifies that there's an exception for flaring where you won't, if you have flaring, you don't necessarily lose the ITC. Final piece on biogas, people had asked for clarification that you could have separate ownership of different parts of the biogas project. The IRS kind of declined to provide a special rule on separate ownership, but the preamble suggests that the revisions that they made under biogas should help the industry get comfortable. So not entirely clear how much comfort we're really going to be taking on that front. I think that's to be seen as people kind of work through the regulations. But so that was one where they did spend a fair amount of effort kind of addressing people's comments in terms of the definitional issues that we've been facing.
Yeah, I feel like so for folks who don't know, when Treasury puts out regulations, they include a preamble where they often talk about the comments and kind of how they form their decisions with respect to the regulations. And they probably spent, I'm gonna guess 10 or 15 pages talking about qualified biogas. I mean, it was a real big discussion. And yeah, you point out there was a really helpful statement. It's like, oh, we think that, I'm paraphrasing obviously, but we think taxpayers will be really happy with how we've addressed this. And then I'm like looking at the regs, and I was having a hard time parsing that and just seeing, I was expecting something a little bit more obvious than in the regs themselves. But then just anticipating based on the preamble questions.
Yeah, that's right, John. I think if you look at the actual changes to the regulatory language for biogas, there's that flaring exception that I mentioned, the thing about the gas upgrading. But I don't think they did any specific change relating to the overall ownership.
No,
So a bit
no, they didn't.
unclear from that point. Go ahead,
Right.
Mark.
But yeah, I'm just gonna add, I think they deleted language about gas upgrading equipment not being a functionally interdependent component of the energy property. And so, just going back, I think we kind of touched on this, but overall with the biogas, I think that distinction is really important, concept. If you fall within the, unit of energy property, where you have functionally interdependent components that operate together, like a, wind turbine or the solar, based on the number of inverters, the taxpayer to claim the ITC has to own the entire unit or at least a fractional interest in the entire unit. Whereas when you have something that's integral, which is the other category, which is not specific to, the either intended function under the statute, but sort of part of the overall intended function of the facility, like power conditioning equipment or transfer equipment or like inverters and things like that. That type of equipment can be shared. So understanding what category you're in there is helpful. And also if you just own a piece of the integral property, but not part of the component that's functionally interdependent component of the energy property, like maybe where the gas upgrading equipment would be, then you wouldn't be able to claim the ITC. Just owning a transformer is not enough. But one taxpayer can own a solar facility, one can own a wind facility, and they can share a transformer and both claim an ITC based on sort of their allocated interest in the transformer.
Also, geothermal didn't fare quite as well as qualified biogas. I thought it was interesting that Treasury decided to spell out case law, starting with like Frank Blyan, which was like I think 1933, about what it means to be an owner for tax purposes. And I think the issue with geothermal is that you put all this stuff into the earth and on someone else's property, and it's what's known as limited use property. So it's probably the landowners, because that could have gone a different way, right? Is that they could have adopted a similar rule for qualified biogas and allowed some kind of bifurcation.
Yeah, although I think they're saying they don't have the regulatory authority to override the limited use rule because it's been established in the tax law.
Yeah,
going back.
and with biogas, the statute does specifically say clean and conditioned gas, although it's never defined. And it's not defined in the regulations either, but maybe they think they have more statutory authority there, and gas upgrading equipment seems like it was intended to be part of that.
Now we do have a question about BESS augmentation. So Mark, you were talking about retrofitting and satisfying the 80-20 rule. That's the exception, right? Is that if you're basically adding to your battery and you're adding, I believe it's at least 5 megawatts, then you get to treat that as new ITC property, which is an interesting acknowledgement that augmentation is a pretty common thing. Anything else we should be talking about energy property before we move on and talk about energy projects, guys?
Well, I would just add to what Mark was saying a minute ago or so there. It's really in the details of what do you think is functionally interdependent, what do you think is integral, and who's owning which pieces of what. So you do have to be pretty careful looking at projects and then kind of comparing them to the examples and explanations in the regulations to get comfortable that you're qualifying for ITC.
Yeah, actually, before we move on to the next subject, maybe we could cover a couple of these questions that were being asked. So one person's asking, with respect to qualified biogas property, they took the ITC without including the upgrading equipment in their basis. Is there an opportunity now with the final regs to, I don't know, amend maybe a prior year tax return to claim additional ITC? If you view the final regs as not really changing the law, I suppose there is the ability to do that. What do you guys?
Yeah, I would think so. Yeah,
Yeah.
assuming that your period to amend is open, but it should. I mean,
Yeah.
it should be given the.
And then we have a question here. There were a lot of comments. People were asking questions and asking Treasury to help understand how you actually calculate basis, right? And Treasury declined to do that, but they did include a statement which was also in the proposed regs, and to make clear that certain intangibles were not viewed as energy property, right? Power purchase agreements, goodwill, going concern value, renewable energy certificates. And our question that we have here is whether by having the definition of energy property being very unit and component based, is there a is Treasury basically saying that the preferred way of valuing energy property is using a cost approach and not an income approach, which would be dependent on a PPA, for example? And I always kind of read like the fact that they were calling out these various things is really kind of going to underscoring like some of the positions that the government is taking, like the Alta Wind case with respect to going concern value, and basically just make it clear that, hey, we see that as something that if that exists, right, it's going to attract value away from the tangible property, as opposed to suggesting that one appraisal methodology for the tangible property is preferable to another. That's not the same as saying that I'm sure that the IRS feels like the whatever valuation method gets you the lower number is probably the one that they prefer, but I don't really see that they're throwing out the income approach. You guys see that differently?
No, I agree with that. I don't think that I wouldn't read the regs as trying to change this kind of very well established overall three methods of appraisal that we.
Yeah, I think that the regulations, are clear that they're not getting into specifics on valuations, how you allocate certain things to, RECs or anything like that, and not really addressing it. And so sort of this idea that intangibles don't count, I think goes back a long time. So I don't think it's necessarily favoring a method.
Yeah. I think that by mentioning battery augmentation, our board is lit up with battery augmentation questions. I'm not sure we'll get to all those today, but we'll try to provide some specific answers after the call, which will be made available to folks. Ala, why don't we change our slide? Okay, so we want to talk about energy projects a little bit now. Energy projects is a concept that really came into being when we started having to deal with started construction. And then we had proposed regulations trying to pull together what it means to have an energy project. And that was for purposes of PWA, the domestic content energy community adders. And the idea is that when you have a utility scale solar project or a big wind project claiming ITC, you have multiple units of energy property that are part of one project. And when should you be looking at that as a single energy project, and then applying the things like started construction, the tests on an energy project basis, or when you should be looking at it as separate energy projects. So the proposed rules that came out basically provided a test that was a little different than the test under started construction, the IRS notices, which basically said that if the proposed regs basically say that if you have multiple energy projects, that they will be treated as a single energy project. So it's not at the election of the taxpayer. It's not a facts and circumstances. It's an absolute. If at any point during the construction they're owned by a single taxpayer and meet 2 or more of the following factors. So you'll see on the screen we've listed the factors. It's not hard when you look at this list. It's not hard to think about projects that had no one ever intended for projects to be grouped together and to be treated as a single project. One of the actually, I think it was several of the commenters on this issue raised questions about how this should apply to residential solar, right? So if I'm a residential solar developer and I have 10,000 systems that I built, all pursuant to a common construction agreements or common loan agreements, do I combine them into a single energy project? That doesn't seem like that's the right answer, but you can certainly read the proposed rules that way. So it created questions and it created just some issues associated with how you actually make this determination. The final regs really clean that up a little bit. Can we go to the next slide?
Yeah, so
Wolf, why don't you run us through this?
yeah, so John, they kind of modified the rule that they had in the proposed regulations to say instead of any 2 factors, you need 4. So the idea there is instead of hitting 2 sort of by accident on things that you didn't think you would need to combine, they've made that bar a little bit higher. So to try to avoid that lumping together of things that really shouldn't be thought of as the same. So it's you now have to have 4 to be considered together. But then the other big piece that they provided is, and you measure that whether you have these common factors at the election of the taxpayer, either during construction, which was the proposed rule, or when the final piece of energy property is placed in service. So it gives you more flexibility of if you want to combine things, maybe you would decide to combine them during construction. If you want to have things separate, then maybe you want to split them off before you're placing them in service. So it is helpful in the sense that it gives us a little more control as compared to the proposed rules on when things are going to get combined together and when things are going to be treated separately. But it doesn't give us an entirely free hand. And as you were mentioning, it's easy to imagine a situation where you hit 2 factors that you wouldn't have thought you're lumping things together. I could also see situations where you do end up hitting 4, even though you hadn't thought that you should lump them together. Because, for example, you could have a common substation, a common intertie, maybe a common construction contract because you happen to negotiate with your EPC contractor together, and maybe you have common permits. So that gets you to 4, kind of easily, perhaps on 2 different projects that everybody's thinking of as separate projects. So not a totally a favorable rule in that sense, in that we don't necessarily have as much flexibility as we would like. But Treasury in the preambles addressing the comments said, some people had said it should be based on facts and circumstances, or sort of at the election of the taxpayer, how to apply the factors. They said, no, we need to have a pretty definitive rule to figure out how to lump things together for purposes of these adders. And so therefore, they're not going to give taxpayers a totally free hand in this regard.
It might be good to just kind of, Mark, I'm going to pick on you to describe, I'll describe an example, and you can kind of tell us how, the issues with maybe some uncertainty. So if I'm developing a big solar project and have storage together, and I feel pretty confident that I can satisfy domestic content on the storage, but if I look at them together, I'll fail, right? So what do I do in that situation? Am I just still just a question?
Yeah, I mean, well, one of the, obviously looking through the factors to see where you fall, whether you meet the factors. I think the other thing is the timing rule. I think that fact set may have been discussed in the preamble where, if you do have, co-located properties, maybe they are placed in service in different times. I mean, and so if you have something where you have, co-located battery storage, maybe that's placed in service later or something like that, like a different phase of the project. This rule, like maybe you can take advantage of this election here where you look at when the last energy property is placed in service, and maybe that gets you out of it. But yeah.
Probably a little easier to separate them now, right? I mean, we do have the benefit of having to satisfy for it to be viewed together.
Yeah.
But yeah, you could still find yourself in a bad fact pattern inadvertently. And I feel like it's really, it becomes most relevant, I think, on that domestic content calculation, right? Because I mean, it could come up for any of the others, but it just feels like that's the one that people most want to kind of separate one part of the energy project from another part of it. So they really don't want them to be viewed together. Then the other thing that is kind of interesting about energy project determination is that we're talking about units of energy property. That's not, those aren't qualified facilities under section 45. So you're not combining PDC properties with ITC properties under the energy project definition, which we get a lot of questions about. Not really associated with energy projects, but I guess it kind of overlaps both it and the energy property question. Is we are getting some questions about before the IRA, before we had a standalone storage ITC, we would always be looking at storage as usually part of a solar project, right? And kind of looking at like how much it was charged from the solar aspect, because we were really just trying to get the credit on the battery as solar energy property. I feel like and I feel like this is pretty clear with both with the change in statute and the regs, is that is just gone away, right? It's like we have a separate ITC for batteries, so I don't think it's ever really viewed as solar energy property. What do y'all think? Am I stumping my team? I mean, do we still,
Yeah.
is it possible you could still keep a count of battery as solar?
Well, I'm just trying to think if there'd be a fact pattern where you would need it, right? Like where you're not going to get the benefit of the battery ITC, but you could get it if it was part of solar.
Yeah, I'm thinking you don't really need it. I don't know if it's really important. And
if it doesn't meet the size requirements, maybe. Battery.
Oh, yeah, well, that's interesting. Yeah, okay. All right, well, we don't have all the answers. We just know a lot of the questions. So, okay, so anything else on energy projects before we move on to the next one?
Nothing.
Okay.
Agreed. Let's move on to interconnection.
Mark, you want to talk us through this a little bit?
Yeah, sure. So qualified interconnection cost, this was something that was added with the Inflation Reduction Act. Basically, for purposes of determining ITC, energy property can include amounts that are paid or incurred by a taxpayer for what is referred to as qualified interconnection property. But there's a limitation there that it has to have a maximum output of not greater than 5 megawatts. And it consists of tangible property required to modify and upgrade transmission or distribution systems beyond the point of interconnection. And I think the questions that are kind of covered in the proposed regulations as well, but hopefully in these final regulations are that for purposes of the 5 megawatt limitation, going back earlier, we talked about the unit of energy property kind of being important throughout these regulations. A unit of energy property, said earlier, consists of this, all the solar panels connected to a common inverter, with the inverter being an integral piece. And this 5 megawatt limitation for qualified interconnection properties also measured at the energy property level. So you could have a larger energy project, going back to the previous slide, that's made up of multiple energy properties where certain energy properties could meet this 5 megawatt or less exception under the statute and qualify. And both the proposed regulations and the final regulations had a number of examples that clarified this can happen even if there's shared integral property between two different energy properties, or if you have a common point of interconnection with a larger energy project that has multiple energy properties with a common point of interconnection, or even if you have energy properties that meet the single energy project definition that we just recently discussed, because you meet 4 or more of those factors. And so in each of those cases, there are examples where the property still gets the qualified interconnection cost. There were comments to Treasury that said that maybe the Treasury should clarify these size limitations and how this 5 megawatt limitation works to prevent larger projects from sort of gaming the system and possibly having dividing up large projects into smaller properties. And the IRS did respond to that and rejected it and noted that in the statute, the 5 megawatt limitation is defined by reference to energy property. And so the energy property definition that we discussed earlier is important. It's not the 5 megawatts with respect to the energy project, which is used in some of the sections like we just mentioned, prevailing wage and some of the adders. And so it is the energy property that it's focused on.
Yeah, it's I think that's a right way of looking at the statute, but I wonder if that was really what was intended. I mean, Mark, what do you think?
I mean, I thought it was surprising. I mean, I don't think I anticipated that when the proposed rules came out and had to read them a few times to see, because it didn't seem like there'd be much need for why it seemed like it was for lower energy output facilities or properties. And I think this property project distinction has always been kind of troublesome, and I don't think the words are always used very carefully, even in the statute. But it seems to have made been a big distinction for Treasury when it's looking at these regulations and pointing to what uses the word property when it says 5 megawatt. But I also have a hard time believing that was the intention.
Yeah,
Well, I think the counter argument to that, Mark, really, right, is if it was intended to apply at the project level at 5 megawatts, I don't think there's a lot of projects, 5 megawatt or smaller facilities that really need, a significant amount of interconnection upgrades. And so therefore that whole category, if you read it the less favorable way, which luckily Treasury didn't, then that whole category of qualified interconnection cost kind of isn't really a category in a sense that probably no one gets to use it. So I think it was.
But then I guess my only thought then is, why include a limitation at all?
Right.
Just say,
No, I agree. Yeah,
as long as
exactly.
you are have tangible, paying your incurring costs for this kind of property for the interconnection, you can include it in your basis. So the 5 megawatt exception, it's hard. It seems artificial. It's hard to figure out what the policy is then if the idea is you can divide a like a solar project by the inverters. You could have a very large solar project that divides up into multiple energy properties, and it's not clear what the purpose is, but it does, appear that the regulations have been drafted to work that way.
Yeah, I think the questions on that policy point, Mark, that you're pointing out was what was making people kind of hesitant under the
Right.
proposed regulations to
Right.
really follow that favorable reading, even though the proposed regulations use that favorable reading as well. So I think now that they've finalized it, it's pretty clear that they've landed on a decision in terms of how to interpret that policy point.
Yeah, so this is a takeaway for our developers that are listening in, is if you're basically paying if you're paying for interconnection costs, right? If you're basically required to pay that from the utility or to connect your project, count your inverters, right? To make sure that each one of your units of energy property is below that 5 megawatt limitation, and you're going to count all those costs into your basis for ITC purposes. Although one thing that I feel like they've clouded this a little bit is that there was always a question when this rule came out. There was a question. It's like, okay, this is the ITC rule, but how do we actually amortize or depreciate or expense those cooperative interconnection costs? Is it just, do we just treat it just like the solar asset that the costs are expended on, which would be like a 5-year maker's depreciation? And the rules, the preamble, and it came into the regs, is very clear and saying, hey, this is not energy property. So, and that, it's important because it's not relevant for DC and EC adder, so we don't have to worry about like satisfying domestic content for stuff that's going to utility. But I think it also kind of complicates the question about saying, oh, well, I can treat it for energy property for depreciation purposes. So I feel like that's something that, I mean, that was never going to be addressed here because that's not an ITC rule, but I do think that there's still some questions associated with that. Okay, qualified interconnection costs. So yeah, it's great to see guidance there. I think it's really helpful for taxpayers and from planning purposes. And I think that we're going to start seeing that making its way into our transactions a lot more because of the confirmation and the final regs that they didn't blow it in the proposed. So yeah, so those are really kind of the main categories that we wanted to talk about from the final regs. When sending out the invites for this, we got lots of questions in advance, and some have posted them here with respect to change in tax law risk and what's protected and what's at risk. And we actually did a webinar on that. You can go to the resources page here on at the bottom of the screen, and you get a link to our webinar talking about post-election. But we did want to talk a little bit about it today because we know it's on everyone's mind. Olive, can you go to the next slide? So we're of the view, and I think most in the market are in the view that the current law that we've been living with is pretty much mostly going to stay in place, but we do all expect that there's going to be some changes around the edges. Things that we feel that are at risk are the EV credits, any kind of benefit that is on application, right, and kind of dealing with Treasury, like or an executive branch agency. So it's like the DOE loan program and things like that. We could see that the spigot could be turned off on those even without changing the law. But getting rid of the tech neutral credits or creating a sunset for them that's different than what's currently in place, or getting rid of domestic content and things like that, those would all require legislative change. It's actually a bill proposed in Congress that's signed by the president. And what you kind of look at when you see IRA benefits is that a ton of those benefits are going to Republican or battleground districts. And because of that, we think it's just unlikely that you're going to see a full repeal of the IRA, even though it does represent a very juicy pot of offsets to offset things like corporate tax cuts. Um, uh, there's 18 House Republicans are on record opposing full repeal. I think that 15 of them are still in the House. So while we don't know what's going to happen for sure, well, we do feel like it's unlikely that we're going to see that full repeal. We have a question about the current ITC being extended, and whether there's a discussion on that. Because the tech neutral ITC requires an energy generation aspect of it. If you were qualifying for the ITC under like a thermal storage or something like that, you don't look so well under the tech neutral credits. Guys, I haven't heard of anyone talking about that there's going to be an extension.
No, I haven't.
Yeah. So I think that's probably unlikely. And I know that lots of people, because we've certainly dealt with lots of clients who are implementing started construction strategies right now, to have some optionality in case the tech neutral credits went away, with the idea that as long as I start construction this year, my project, I can stay under the existing Section 48. I feel like the tech neutral credits will probably stick around. I mean, I don't know, Mark, what do you think?
Yeah, I'm not aware of anything to suggest otherwise, and there is a sunset provision built in, but yeah, I think so too.
Yeah. The one thing though that, oh, and I guess we get the question also is like these final regs, are they at risk of being repealed? When you enact regulations so close to the end of a Congress, you fall under what's known as a Congressional Review Act, which allows Congress to take a look at those regulations, and it just has kind of a lower standard of basically getting rid of them. But when I kind of look and see what's in these final regs, I don't feel like there's much risk that these are going to be repealed. I feel like the bigger risk is that we'll never see final regs on the tech neutral credits.
Right.
Or we'll be talking about that in 10 years. And that would be troubling because sometimes when you have proposed regs, they tell you that you can rely on them until there's final regs, and the tech neutral proposed regs did not include a statement like that. So I think that's kind of creates some concern for some folks. So we do think it's difficult when once again, when you're thinking about changing tax law, of how do you pick winners and losers based on kind of where this money is being outsourced. And then the other thing that I think is complicating it is that Trump has made so many statements to really increase energy production, just becoming a global energy producer, and really focusing on the need for more generation. That it seems like we'll probably just see not necessarily disfavor towards renewables, but certainly just kind of a more of a kind of all-inclusive energy generation. So I think we'll certainly see LNG projects. I think we'll certainly see we could see a reemergence of nuclear project, which I know that has bipartisan support. And then what about we get questions about transferability. Do we think that that's on the chopping block? Wolf, what do you think?
I don't think so. I mean, there's been a lot of kind of effort devoted to kind of creating an industry of being able to sell these credits. So I would hope that they wouldn't try to pare that back. And people had been pushing for transferability for years, right, to try to simplify how we take advantage of these credits. And so from that perspective, I don't know that there's really a policy, any particular policy reason to make the credit not transferable if, as a policy matter, you feel like the project should get a credit, should be incentivized in that way. All that said, I do think transferability in terms of revenue scoring maybe does become a target. So hard to predict, but at least I would hope not that it's not pared back.
Yeah, I'd also, yeah, I would hope not as well. I'd also add that it might be helpful that there's a lot more, interested parties. There's a lot of tax credit buyers that we've seen, obviously that have not, previously been involved in this space. And so it's really opened up the number of people that are interested. And, there's a large market with a large number of people who are relying on it. So that hopefully that helps make it more difficult as well, you'd think.
Yeah, I mean, at the end of the day, if Trump is looking to either extend the Tax Cuts and Jobs Act, which is set to expire beginning next year, or provide additional corporate tax cuts, there will need to be an offset, right, to kind of make it work, because the general thinking is that it has to be under budget reconciliation. So how you kind of bridge that is the big question. But it is kind of interesting when you think about transferability. And Wolf, I think you have a great point, right? It's like, okay, the benefits are there. It really shouldn't be the answer that, oh, we're going to create a bunch of benefits, encourage activity, but then we're going to assume that people can't actually benefit from it. So then we don't have to count it. It's like, no, transferability really shouldn't change the way you look at this. It's just
other than pure revenue scoring, I would say.
It's pure revenue. Yeah, it just is a math problem, right? So then it just becomes a math problem.
But note that it helps some of the credits, I think, that people feel are less at risk, right? Like the 45Q carbon sequestration credit benefits greatly from transferability. So why, if we're from that perspective, you would think they would want to keep the concept of transferability. And therefore, why would you cut it back for some of the credits but not all of them?
Right. Which is the problem of picking winners and losers, right? So you kind of think it's like the probably the more appropriate way, I would think, is to keep transferability in place, and then if you need to kind of make some changes around the edges on what you're incentivizing, that's where you make
yes.
moves. So
yeah, policy wise, that would make more sense.
Yeah, because that's in DC everything makes sense here, so that's what it's kind of on that. Well, folks, we're kind of coming down to the wire here. We really appreciate you joining us today. We do kind of feel like in seeing these regs coming out so close to the end of the Biden administration, is that I personally take that as an indication that we're going to see a lot more that maybe some of us have been waiting for a long time, right? But I think we're going to see a lot more happening here between now and the end of the administration. So while we did talk about the fact that we don't have final regs on the tech neutral credits, they've already gone through the public comment period, so they could be released, right? It's like there's nothing really holding back on that. And then the others is we're still waiting for proposed regs talking on domestic content and energy community. Although, I was thinking about that, it's kind of interesting to think is like, I've always kind of thought that those would come out independent of other things, but that's under Section 45, right? So it's just like, so I guess it would be just a new provision under 45 for those proposed regs. So we'll see if we get those. And if we do, we'll likely hold another one of these things. So once again, really appreciate everyone joining today. This program is recorded. Feel free to share it with your friends or people you don't like. I don't know, you decide. And just once again, thanks for your time today.
Yep. Thanks everyone for joining us.